this? Okay. Sorry about that. So thank you all for joining me tonight. My name is Dawn Santoriello, and I'm the president of DS Financial Strategies. And my goal in life is to help you reach your financial goals with peace of mind and economic confidence. So tonight I'm going to share with you the effect of the election on your portfolio. And I think you might be in for a real surprise. It's a real eye-opener. So let's get started. Let me just start by sharing my screen here. And if you do have any questions, I just ask that you hold them till the end because it's just me running the show here and I can't see anything you're typing in the chat feature there. But if you want, you could go give this video a like and share with your friends and everyone who you think might benefit from this message. Also, go like my page, DS Financial Strategies, and let's begin. Let me get this in. I'm hoping this is showing the proper way. Let me just get this in. Here we go. Okay, so let's go. So now this is the biggest house. That's the focus of everything that you hear in the news right now. It's all about who's going to remain in the seat or who's going to take control of the seat. So let's look back. Last year at this time, investors' top concerns were the upcoming election. That was the biggest concern on people's minds. And then besides that, you could see everything else. So a year ago, people were still kind of worried about their portfolio and everything. And these are the two guys, whether you love them or hate them, these are the choices that we're with. And most people are favor one over the other, and they're afraid of what the person who they don't favor is going to do. So we're going to see what that's actually going to mean for your portfolio shortly, so that you could have peace of mind and vote for whoever you feel that you like and not have to worry about its effect on your portfolio. So, and here's who actually wins and what wins an election every time, whether you're a Democrat or a Republican. Discipline is what wins every election. So election outcomes, like markets, they're unpredictable and are far less important to your investing success than you might think. But because we have the news media, and how do they make money? By selling advertising. So they're going to scare the hell out of you just to make money, whether it's true or not. And then and how many of you out there are saying, you know what, I'm going to wait and see. That is not a strategy for success. I'm going to wait and see who's going to become the president. And then I'm going to just wait and see how that's going to look. Well, what's going to happen is you're going to be waiting a whole lot because something's always going to come along. So you're going to be seeing a lot and not doing anything because you're not going to know when to get back in. And then we're going to learn some simple strategies for investing success during the election years and beyond. So let's get started. So as I said, election outcomes like markets, they're unpredictable and they're far less important to your investing success than you might think. So in 2016, right up until the election, this is what the news media was reporting. As you could see, it all favored the Democrats and particularly Hillary Clinton. And we all know how that turned out.
Markets responded dramatically, as we've been discussing, to the current lead by Donald Trump in the Electoral College count. I'm going to bring Bloomberg's Joe Weisenthal and Guy Johnson, along with RBC Capital Markets Chief U.S. Market Strategist Jonathan Dollop. Jonathan, we were talking a few moments ago before that news came in from Florida, just about the degree to which the market may have priced in a Hillary Clinton victory. Your reaction to what we've seen so far tonight?
Well, I mean, obviously the news is a shock, and all evening, instead of watching, obviously watching the electoral map, but I'm watching what the market is doing. I'm watching the S&P. I'm watching the Mexican peso, and it's telling me what the odds of a Trump victory is. We put out a note today saying if Trump wins over the next couple of days, it's a 10 to 12% market pullback.
Okay, remember that, what that guy just said.
We are closely tracking Wall Street's reaction to Donald Trump winning.
Oh, you know what? Too soon. Let me go back to the other one. Well, as that guy just said, the reporters, they were shocked because they weren't expecting Trump to win. And boom, out of nowhere, he just won. And they predicted a loss of 10 to 12%, that guy predicted that would happen now with Trump in the presidency. So now let's see what actually happened.
We are closely tracking Wall Street's reaction to Donald Trump winning the White House. Dow Jones futures tanked on election night going into Wednesday morning, but then the Dow closed up 250 points yesterday, and today the Dow surged to a new record high at one point, and right now it is currently up over 200 points.
So I guess the experts got it wrong with their predictions. They didn't go down 10 to 12%. The market actually went up the next day. So, and again, this happened again in history back in when Truman was running. But the night before, they claimed that Dewey won, and then they woke up to find out No, he didn't actually win. So these predictions are that, predictions. And now let's take a look at some of the presidents through history. So let's look at the Democrats. So Harry Truman, he served 2 terms, and we could see that he had 2 economic expansions, 1 recession, debt to GDP was 71%. But look at the returns. For the first term, did 35.1% the market. The second term, 128% the market did great. Again, that was pretty good. Now, then after him, Dwight Eisenhower, a Republican, gets into office. He had 2 economic expansions, 3 recessions, and debt to GDP was 54%. Let's see how that did. Well, the market, the first term, 111%. Second term, 43.7%. Not bad, very good. Then we get another Democrat, John F. Kennedy. The short term that he was in before the unfortunate tragedy, we had 1 economic expansion and debt to GDP was 49%. How did that fare out? 34.7%. Not bad. Then the next president coming in, Johnson, having to take over all that turmoil and everything. So we didn't have no economic expansions or recessions, and 65.6 and 39.2 over the first and 2-year terms. Not bad for dealing with all that chaos that was happening in the country, especially from the assassination. Then we get into the 70s. We have Richard Nixon, a Republican. 1 economic expansion, 2 recessions, debt to GDP, 31%. First return, 28% return. Second term, 29%. And this was in the 70s with a lot of other stuff that was happening as well. Oil prices, the wars, all that kind of stuff that was happening. Then we get Gerald Ford, or also another Republican. Economic expansion went up 1, 0 recessions, low debt to GDP ratio, and returns. First term, 50%. Then they have Jimmy Carter, who, again, now we have another Democrat in office. An economic expansion, 1 recession, debt to GDP, 32%. Cumulative return for his year was 55% for his first term. Again, not bad. Then we have Ronald Reagan. So we have a lot of stuff going on, stagflation, all that good stuff in the year of the 80s and coming off of that from the 70s. So again, 1 economic expansion, recession, debt to GDP, 50%. His term, first term, 50%, 98.2%. I hope you kind of get what I'm trying to say, that the markets don't care who's president, Republican, Democrat, it doesn't matter. Recessions, expansions, the market doesn't care. The market is going up. Then we get to George Bush, the first one, George H.W. Bush. Again, we had 1 economic expansion, a recession, debt to GDP. And how did he do? 72.7%. Then we get Clinton, which was filled with scandals. And this is what he did, 98.8%, 83%. So hope this is politically correct, but the stock market doesn't care who you sleep with and what kind of scandals you have. You're still going to get the returns. And then we have George W. Bush. Now, this was horrible. He inherited the whole coming off of the dot-com crash, the tragedy of 9/11. And he encountered 2 recessions, 1 economic expansion, debt to GDP was 68%. So his returns were negative 6.6 and 25.8%. But what I failed to tell you in all this, these are the S&P 500. But luckily, everyone is not just invested only in the S&P 500. If you're working with an advisor, you should be globally diversified. So this lost decade would not have affected you as nearly as bad as if you were only based in U.S. securities, which most of you weren't. Otherwise, you'll hear the news media tell, oh, it's the lost decade. Well, only for that sector, but you are globally diversified and you're working with someone who helps you. And let's take a look at Obama, a Democrat. Debt to GDP was 104, 1 expansion, 0 recessions, 44.8%, 66.4 second term, not bad. And then here we have Donald Trump, not fully off of his 1-year term. Debt to GDP, 131%, 1 recession. Cumulative return so far, 51.5%, not bad. So as you can see, and I want to repeat this, the markets do not care if we have a Republican or a Democrat president. The markets are going to do what the markets are going to do, and discipline is always going to win. So take faith in that and go vote for the guy that you like, or the one that you like more than the other. Whoever your choice is, just know that it's not going to have an impact on your portfolio the way that you think it is. And here's the proof. Don't take my word for it. Here, the markets have rewarded long-term investors regardless of the president or political party they favored. So as you can see, from 1926 all the way up into 2019, it's an upward trend to the right. So more evidence that just shows you the markets don't care who is president. And again, Democrats versus Republican. Doesn't matter, the markets are still going up. So now let's look at the people that say, you know what, I'm just gonna wait and see. Wait and see for what? Because as soon as something happens, you're like, okay, now I'm gonna wait and see for the next thing. And you're missing out on all the gains. So let's take a look at how that strategy works, because it is not a strategy for success. So how many of you are out there saying, you know what, I'm just gonna wait and see right now how this election plays out before I do anything? Don't be afraid to raise your hand. I can't see you because I'm on the record. I'm over here. I can't see the chat feature. So let's answer the question, does volatility spike during elections? Let's see, let's look at the volatility index for the S&P 500. For the full term from 1964 to 2019, it's 15.7%. So 100 days before the presidential election, it's 13.8%. Oh no, there goes, I just went and busted that myth. So the market isn't more volatile before the election. Okay, so now you're thinking, well, no, I know there is volatility, so it must be the first 100 days after the election. Let's see if that answer's right. Wrong again. The market is even, again, it stays the same, lower than the average volatility for the full time of the stock market from 1964 to 2019. So the markets tend to ignore elections. The market is going to do what it's going to do, and that's trending upward, as long as you're in it for the long haul. And don't make mistakes of getting out because you're fear. Again, the media is driving fear, and that's what they get paid to do, because they're selling you. They're selling you. Your eyes and your ears are what brings them money. They have to scare you so they make money. So remember, who has your best interest at heart? Trust your advisor. Well, make sure they're a good advisor. If you're not happy with them, I'd be happy to help you. They have your best interest at heart because they're a fiduciary and they're not out to make money by selling you different things. They're out to help you reach your financial goals with peace of mind and economic confidence. At least that's what I do for all my clients. So let's take a look at this. So a lot of people are sitting on the sidelines. Americans are hoarding trillions of dollars in cash before the presidential election. Morgan Stanley had found this out because they're waiting to see what happens. But all of you know that you don't need to go do that. Go start investing right now because, as you see, the market doesn't care who is the president, Republican, Democrat, it doesn't matter. And we'll look at how the average fund flows by the year of presidential terms from 1992 to 2019. We can see money flowing out of the equity markets in year one. I mean, money's in the equity markets and it flows out. And then right before that presidential election over there on the screen, if you could see here, follow my chart here, more money is going to flow out from the equity funds and go into the money market funds. Because again, people are scared. They just want to wait and see. So let's just see if we do that, if we wait and see during the election. So we analyzed 22 different election cycles since 1932. So a hypothetical $10,000 invested during an election cycle of 4 years. So the first person is going to do that. They're just going to sit on the sidelines. They're very nervous and don't know what's going to happen. The truth is, nobody knows what's going to happen, as we have seen. Even the experts and news media, they all can get it wrong, which they do. So you're nervous. You're sitting there waiting until January 1st, after the election's over, to fully invest your $10,000. And then this person, the next person, they're going to still contribute to their 401k on a regular basis. They're going to put in $1,000 a month for those 10 months. And then this person, they're not going to be concerned. They're not going to move their money out of the market. They're just going to stay invested and invest their full $10,000 on year one. And again, I forgot to mention this person here too. They're also doing what they call dollar cost averaging because they're afraid to put all their money in at once. And then if you are in a 401k, it's easier to have it coming out of your paycheck weekly or bi-weekly. So here, if this person just sitting on the sidelines, they're going to earn $14,914. The person who is just going to contribute monthly, they're still going to have $15,729. But this person who's not going to try to time the market, is just going to get in there and stay in there no matter what happens, is going to end up with $15,866. Now you're saying, well, Dawn, that's not a big difference, $15,866 from $14,914. Well, let's equate that into percentages. that's a 6% return that you're giving up. So, and for all you people that are afraid to work with an advisor and doing it on your own, all that money, that 6% they saved you is going to earn you more interest, and it's going to save what you would have paid them on fees rather than you sitting alone in cash by yourself. So it blows up that myth too about why you don't want to pay an investor because, oh my God, all these fees I'm going to be paying. Again, just not true. Yes, you're paying fees, but it's to your benefit. Because like I said before in other videos, that investors add advisors add 3% to your bottom line because they're going to keep you invested in times like this when it's highly emotional. And as you can see, the reward for that, for staying in, is you're going to get an extra 6% return versus someone who sits in cash on the sidelines. And sorry, I'm so energetic. I'm just so passionate about this and helping everybody. As you can tell, I love what I do. So now we learned what doesn't work. Let's learn what works. Some simple strategies for investing in success for election times and beyond. So 1, we learned, do not try to predict future markets outcomes based on current news. Again, what is the news media there for? To sell you advertising. So they want to instill fear in you, and fear is the worst thing that you could have. You want to remain calm and grounded, and by working with an advisor, you're going to have that economic confidence and peace of mind because you're not going to care what the so-called media experts and you hear on the news are saying, because you're going to know that you have a proven strategy that works, so you could rely on that and sleep better at night. Number 2, don't mix the political party preference with the success of your portfolio. As we saw, the market doesn't care who is president, if it's a Republican or a Democrat. It just doesn't matter. The markets are going to continue to go up. And finally, your behavior is more likely to affect your retirement than any election will. And as we can see here, here's the gap of the behavior gap. The investment return that you will get if you stay in the market. But what most investors, they don't get that. They don't get the market return. You saw like 55%. Everything was above like a 50 and above, maybe 35% and above over those time periods. But most investors didn't get that because they got scared and they did what most scared investors do. And this also scared fear goes for smart investors and for investors who are not so smart. It doesn't care if you're smart or not so smart. Fear will crush your portfolio every time because you're going to move to cash and not get the returns that you would normally have gotten if you just stayed in the market. So stay put, manage your portfolio based on your emotional risk score. If you don't know what that is, give me a call and I can make sure your portfolio is designed for your emotional risk score. So again, these are the 3 things to do. Do these 3 things and your portfolio will survive. It's survived many things in the past. That brings me to my next point. A lot of people say, well, you know what? This time it's different. Oh my God, we have huge debt growth and we have this. We just had a pandemic. We never had that before. This time is different. Well, there are so many times in history, which I think I might be getting ahead of myself here, that it's always been different. Well, and each time that it's always been different, the market still has swung up. And again, I want to drive this home. Discipline is what wins every election. So, and the evidence, as you can clearly see, shows that you should go vote for your candidate with confidence that it's not going to affect your portfolio because the market doesn't care who wins. So the best thing to do is invest with evidence. So I'm going to stop sharing my screen. Oh, you know what? Here, I got to put up my disclosure. So I want to see if there's any questions in the live chat. So let me see how I can switch over to do that. Let's see if I minimize this. Again, doing everything on my own here, trying to run the social media chat and everything. Here we go. Okay. Well, it looks like no one's been watching. So, well, hopefully you'll get to this sometime later tonight or tomorrow, because again, this was really good information. And the biggest surprise, the biggest shocker is that, what is it, everyone? The market does not care who becomes president. So thank you, and I hope you all have a great night. Again, my name is Dawn Santoriello. If you want to reach out to me, you can reach out to me on 215-660-0288. Feel free to find me on social media. And if you like this video, there's also other great myth-busting videos I have on my YouTube channel, which is under DS Financial Strategies, called Financial Fridays with Dawn. So shoot me a comment. I'd love to touch base with you, and have a great night. Thank you so much for watching.